Hello, I'm Kristen King, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. We all know it's been a wild ride in the stock market this year. So today, we'll take a look at the possibility that the S&P 500 could hit 3,700 in 2021. Now, we haven't picked that number out of thin air. 3,700 was first floated back in January this year by JP Morgan technical analysts who highlighted the possibility of a rally from the level at the time, 3,280. The idea was that a period of consolidation would form a base for the rally to lift off from, and well, we got a bit more than a consolidation a few weeks later. However, U.S. markets bounced back strongly, and the S&P 500 is now over 50% above its 2020 low point. We're now 1 month into the last quarter of 2020 and just 1 month away from the U.S. presidential election, and the 3,700 figure is back in the headlines once more. Bank of America analysts have suggested that number as a base case valuation for the S&P 500, regardless of who wins in November. So, what are the prospects for continued gains in the S&P 500? Well, we can get a feel for the underlying health of the market by looking at how stocks are trading relative to longer-term moving averages. And on this measure, the data looks encouraging, with 72.47% of S&P stocks trading at prices above their 100-day moving average, while 62.57% are above their 150-day moving average. 58.61% of stocks in the index are above the all-important 200-day moving average line. If we look at the momentum in the index itself, we find that over the last 6 months, we have seen 44 new highs. However, that rate falls to just 33 in the last 3 months and just 3 in the last 30 days. What's more, during the last month, the S&P 500 posted 9 new lows as well. The earnings picture is turning a corner too. FactSet Research reports that the number of S&P 500 companies issuing negative guidance on their Q3 2020 earnings has fallen sharply compared to prior periods and the 5-year averages for the S&P constituents. However, the overall number of S&P 500 companies issuing any guidance at all for Q3 2020 has also fallen back dramatically to 36% below the 5-year rolling average figure. Limited visibility about earnings has to count as a negative as far as the S&P 500 is concerned, with Q3 2020 earnings season set to get underway in a little under 2 weeks' time. Trackstar, our proprietary software platform, which tracks the searches and activity of professional investors, can shed some light on what the pros are researching. ETF searches over recent weeks show the SPY ticker for the SPDR S&P 500 ETF featuring most prominently. Of course, what happens to U.S. equity indices very much depends on the performance of a clutch of large tech companies, the so-called FANG stocks. And the third most popular ETF search in recent weeks among institutional traders, according to Trackstar data, is FNGU, an ETF which tracks the 5 FANG names: Facebook, Amazon, Apple, Netflix, and Google's parent company, Alphabet Inc., as well as a basket of other influential tech names. However, this is no ordinary ETF. In fact, it's a 3 times leveraged inverse ETF. That means its price rises when the value of the stocks it tracks falls, and it rises 3 times as much. Effectively, it's a geared bet on that these stocks will fall, and by extension the wider U.S. equity markets too. Wall Street professionals are definitely reflecting on different outcomes for the S&P 500 index ahead of Q3 earnings, a potential stimulus package, and the election, but quite a few are doing so from a negative standpoint. That may mean they are expecting a downside correction rather than a move to new highs. That's all we have time for this week. Remember to make sure you do your own due diligence before making any investment decisions.